When you hear the word options, your mind probably jumps to fast money, high risk, day trading, all that crazy stuff. But what if I told you there's a way to use options for long-term buy and hold investing? That's exactly what we're going to break down right now, a powerful strategy that's hiding in plain sight. So let me just start by asking you this. How would you like to control a portfolio worth over $140,000 by only putting up about $30,000 of your own money? It sounds almost too good to be true, right? But it's the real, tangible power behind the strategy we're about to get into. And here is the absolute key. We are not talking about short-term gambling. This is a tool specifically for the patient, buy and hold investor, the complete opposite of that fast money crowd you usually associate with options. It's all about making your capital work smarter for you over the long haul. All right, so what problem are we actually trying to solve here? Well, it's a classic one that every investor faces, the capital dilemma. To make real money in the market, you usually need to invest a whole lot of money. But what if there was a way around that? You know, this quote really hits the nail on the head. This isn't some wacky new idea, it's just flying under the radar for most people. The best way to think about it is that these special options can act like a form of investment debt, giving you all that leverage without the terrifying risk of a margin call. So, what is this magic tool that makes all this possible? Well, let's pull back the curtain and formally introduce Leap Options. This is the star of the show, the engine behind this entire strategy. So LEAP, it's an acronym, of course. It stands for Long-Term Equity Anticipation Securities. Kind of a mouthful, right? But the name tells you everything you need to know. Unlike regular options that might expire in a few weeks, LEAPs can go out as far as 3 years. And that long-term timeline is what makes them a potential game changer for investors, not just short-term traders. Okay, so let's put these side by side so you can really see the difference. Buying a stock is simple, right? You put up a big chunk of cash, you own the shares, you get the dividends. With a Leap call, it's a totally different game. Your initial capital is way, way lower. You don't actually own the stock, but you own the right to buy it, which gives you incredible leverage. That's why it's often called a stock replacement strategy.
But here's where your spidey sense might be tingling. Wait a minute, even a 3-year option has to expire eventually. And you'd be absolutely right. So how do we make this a true long-term strategy? That's where this brilliant little technique called rolling forward comes into play. This is the secret sauce.
Yeah, this is the core issue, isn't it? As a long-term investor, you're thinking in terms of 5, 10, 20 years. A 3-year option, while it's long for an option, still isn't forever. So how do we bridge that gap? How do we take a contract with a deadline and turn it into a position you can hold for decades? Well, the solution is surprisingly elegant. It's called the option roll forward. Here's how it works step by step. First, you buy a Leap with a 2-year expiration date. Then, you just hold it for 1 year. At that point, you sell that original Leap, which now has 1 year of life left. Then, and here's the key part, you immediately use the money from that sale to buy a brand new 2-year Leap. And boom, you just reset the clock. You can repeat this process year after year, effectively keeping that leverage position going indefinitely. Now, I know this strategy sounds incredibly powerful, and it is. But with great power, well, you know how it goes. This is not a free lunch. There's no such thing in investing, right? So we have to be really clear about the trade-offs, the perils that come along with these potential rewards. So let's just lay it all out there. The upsides are awesome. Massive leverage, a much lower initial cash investment, and you can sleep soundly knowing you'll never get a margin call. But the downsides are just as real. You've got to be ready for a bumpier ride because it's going to be more volatile. You also won't get any dividends the stock pays out. And this is the big one. If the stock price falls below your option strike price, that option can expire completely worthless, a total loss. You have to be okay with that risk going in. But here's an interesting thing about that volatility. It isn't constant. When you first buy that Leap, it's super sensitive to price swings. But as time goes on and the stock price hopefully climbs, your option becomes what's called deep in the money. As that happens, the leverage kind of cools off, the volatility drops, and the investment starts behaving a lot more like the actual stock. The ride gets smoother over time. Okay, enough theory. Let's make this real. We're going to walk through a simplified example from the source material, using one of the most popular ETFs in the world, SPY, which, as you know, tracks the S&P 500. So here's the setup. Let's say SPY is trading for about $144. Instead of buying the shares, we buy a leap option with a strike price of $120. That option only costs us $31.60 for each share we want to control. And our plan is to hold this position for 5 years, rolling it forward when we need to.
So, to control the equivalent of 1,000 shares of the S&P 500, our initial investment isn't the full price. It's just $31,600. That's just a fraction of the total value.
And that's the magic right there. That little $31,000 investment gives us control over a portfolio worth nearly $144,000. That, my friends, is leverage in action.
So what does that do to our returns? Well, if we assume the stock goes up by a pretty normal 8% a year, the leveraged nature of our leap option could turbocharge that into a potential return of over 17% a year on our money. And that is the payoff for taking on that added risk.
So after seeing how it works and seeing the numbers, the question becomes, is this a new tool for your financial toolkit? Now look, it's definitely not for everyone, but you have to admit, it is a seriously powerful concept.
And this quote really brings it all home, doesn't it? The whole goal here is to build long-term portfolios and control much larger investments, but without tying up so much of your hard-earned capital. It is, at its very core, a strategy for capital efficiency.
And that just leaves us with one final thought to chew on. For the right investor, someone with a long-term view who truly understands the risks involved, could this hyper-efficient strategy be the very key to unlocking your portfolio's true potential? It's definitely something worth thinking about.